Hey everyone and welcome back to another video for today. So over the past couple of weeks, the markets have been quite volatile. There are a lot of names that are down significantly and then some others that are not down that much or down at all. If we look at the approximate performance over the past month, we can see that major names are down, have been taken a hit. But then again, you have names like Apple who are still up 3.3%. Google up 17.8%, Amazon flat, Eli Lilly, first pharma company that actually reached $1 trillion in market cap. But then you have other players like Meta down 19%, Oracle down close to 28%, AMD down 14%, and of course many other names out there that have taken quite a hit. But as I've said in previous video, maybe looking at, let's say, more boring names. I call them boring because they're already big companies, established companies that might not have the next 10x, 20x potential, but do still have that market beating potential. Might be the time. It might be the time to look at those names right now and add more if you enjoy those companies, if you enjoy the prices that you're seeing right now. And so in today's video, I do want to touch on 4 companies. Yes, I own those 4 companies: Uber, Amazon, MercadoLibre, and Meta. And of course, just because I talk about those 4 companies does not mean that there aren't another 20 other companies that are trading at very attractive prices right now. Maybe you've been adding to some others. Let me know down in the comment section below. If you enjoy this type of videos, hit all the buttons, would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. And also special thanks to Fiscal.ai, previously FinChat, for sponsoring this video. It's the stock research platform I use every single day. You've seen this in every single video. There's a link down in the description and in the pinned comment. You'll get 15% off. New users will get 2 weeks of Fiscal Pro for free. And of course, all the data that you're seeing in these videos come from this platform. And so first up we have here Uber. Uber is back in the low $80. Year to date, it's still up 32.8%. It's a $174 billion company. Now the trailing P for Uber, yes, it is lower than the forward one. There were some one-time things that happened there. 10.8 times trailing PE, 24.8 times forward PE. But if you look at price to free cash flow, forward one, 16.8 times. It's not expensive in my opinion. Margin-wise, still quite good. Of course, with Uber, to me, the main bear thesis with Uber is if there are only 2 autonomous vehicle companies that will take over 90% of the market, it's going to be a problem for Uber. As long as that doesn't happen, Uber will be fine. Now, looking at Uber's more recent performance, we can see that total revenue increased 20.4% year over year last quarter. Free cash flow, this is one thing that is quite impressive with Uber. This was a money-burning machine previously, and once they flipped that switch, well, it just goes up and to the right. We can see it even better here if we look at the last 12 months and look at free cash flow margin has gone from, let's call it when they really flipped the switch back here, Q4 2022, 2%, let's call it 2% free cash flow margin. We're now at 17.5%. and $8.6 billion in free cash flow generated over the last 12 months. This, of course, also allows them to invest quite a lot, invest in AV companies and also buy back shares and actually do some accelerated buybacks, especially earlier this year when they felt like their stock was extremely undervalued. Looking at operating margin, same thing here over the past couple of years, went from negative to now 9.2%. Return on invested capital for Uber for 25 sits now at 25.5%. And so, all in all, we look at total trips goes up and to the right. Last quarter was actually a pretty strong quarter for them. Monthly active platform customers is up 17.4% last quarter. Total gross bookings 21.4% to 49.74 billion. Mobility revenue also grew a little bit faster than the previous quarter. Delivery revenue up 29% year over year. Then we have freight. It's basically a business that doesn't really grow at the moment. Uber also has we'll call it a significant advertising business. It has a significant subscription business as well, Uber One, which makes sure that the Uber ecosystem grows and becomes stronger and stronger. Uber, to me, under $90, for me, it's an easy add. Looking at the charts real quick, we can see that Thursday Uber took a hit just like a lot of other companies out there. We did go under that 200-day moving average, which sits at $86.9. Now, if we look at the drawdowns here, Uber stock does experience a 5 to 10% drawdown every 4.1 months, 10 to 15% drawdown every 26.2 months. Now, of course, right now, as you can clearly see, we're a bit in no man's land. Could we see a rebound? Maybe, but I am already adding at those levels. Moving on to company number 2, and that's Amazon. Yes, Amazon is literally flat year to date. Amazon stock, of course, has been a stock where, yes, over the last 3 years, it has outperformed. It's up 138%. Over the past 5 years, it's up 42.5%. But, as you know, I love Amazon, huge fan of the company. I'm a shareholder. Amazon is a company worth $2.3 trillion. It's one of those companies where I can say very comfortably it's a buy and hold and buy and forget type of company. Yes, it might not be the cheapest one out there, but then again, Amazon is really a company where every dollar they make, they just reinvest it in the business because they want to grow more. They want to basically grow their total addressable market, which is something that they've been doing for the past 2 decades. But it is cheaper today than it was a couple of years ago, that's for sure. From a PE perspective, from a price to free cash flow, you name it. Now, Amazon is, yes, one of those big companies that does not buy back its own shares, or at least not yet. Oh, and by the way, Amazon's revenue over the last 12 months, $691 billion. I do believe that Amazon is going to be the first company that will generate $1 trillion in revenue in one fiscal year. And yes, I do think that they will be overtaking Walmart as the biggest company revenue generating wise. As you can see, Amazon over the next 2 fiscal years, so fiscal 26 and fiscal 27, they're supposed to grow revenue by about 10%, which means they'll reach $860.76 billion in revenue for fiscal 27. Looking at cash from operations, that is expected to grow 21.5% in fiscal 25 to $140.8 billion, then grow another 21.8% in fiscal 26 and another 20.2% in fiscal 27 to reach $206.53 billion in cash from operations. Now, of course, we know that right now online stores is the part that generates the most revenue for them. Right? Online stores, this is the last 12 months, and then you have physical stores as well. Those are the slow growing business lines for Amazon. But then you have, of course, AWS. Last quarter, we've seen a reacceleration in growth, 20.2% growth. I do think that we're going to see 20+% year-over-year growth in the upcoming quarters. Why is that? Well, the year-over-year comparisons are going to also get a little bit easier. You get the Anthropic clusters coming online, so I do think that that's going to help it. Then you have your $200 billion in RPO. That has increased 22% year over year. But that's not all. You have subscription services. This is also a business, $48 billion over the last 12 months, growing 10.7%. Advertising, growing 20.6% to $64.6 billion. Also, last 12 months, just to show you the sheer scale and size of this business. And so what we're getting right now is Amazon with operating margins of around 11%, a big difference from where it was a couple of years ago. If you look at free cash flow margin, of course, that is quite volatile as well. CapEx does increase and has increased quite quickly over the last couple of fiscal years. Gross profit margin does go up, right? We've been at 40% Q1 2022. We're now closer to 50%. Looking at Amazon's return on invested capital, that sits at 12.5%. I do think that Amazon is one of the best companies at allocating capital. I also think it's just a matter of when, not if, they're going to announce a share buyback program. I don't think a dividend makes sense right now. To me, dividend is really the last thing that I want to see. First, buy back a lot of shares. Then, if you really have that much cash, okay, pay a dividend. And so looking at Amazon right now, you can see that the stock pulled back even lower than where it was before they reported an excellent earnings report. It did, although, a rebound on that 200-day moving average, which sits at $214. With Amazon, 5 to 10% drawdowns happen every 5 months. And every year or so, a 10 to 15% drawdown happens. And yes, I know what people will say, yeah, but Amazon is already too big. What? You cannot 5x, 10x. Okay, maybe so, but I do think that you will be beating the market comfortably over the next couple of years. Moving on to company number 3, and that's of course MercadoLibre. I know. $1,950 per share is too much. When will this company announce a stock split? Honestly, I don't know. I've shown you bookings. Bookings is at what? $4,000, $5,000 per share or something like that. I don't know if or when MercadoLibre will announce a stock split. So unfortunately, yes, it will cost you quite a lot if you don't have access to fractional shares. This is a company worth around $100 billion. Yes, from a PE or this pricing metrics perspective, it's not a cheap stock, has never been a cheap stock. But then again, some companies do always trade at a premium, especially companies with a very nice margin profile and a company that consistently grows top and bottom lines quite rapidly. More specifically, this has been the 27th consecutive quarter of above 30% growth for MercadoLibre. Now, how long will that last? Well, according to the analyst expectations right now, 2026 is the year where they'll only grow 28.2%, and in fiscal 27 they'll only grow 22.2% to reach $44.7 billion in revenue. Looking at total revenue and gross profit over the last 5 years or so, you can see that revenues have increased faster than gross profit. So yes, gross profit margin is coming down. Now looking at cash from operations is expected to grow 18.6% in fiscal 25, 16.8% in fiscal 26, and then a small acceleration, 19.1% year-over-year growth in fiscal 27 to reach around $13 billion in cash from operations. And here you can basically see gross profit margin coming down a little bit, CapEx increasing. I honestly didn't know that CapEx increased by that much, but you can still see that free cash flow margin has been stable despite them increasing CapEx over the last couple of quarters and maybe last couple of years. As for operating margin, this one as well has peaked here. Q3 2023 or so, we're now at 12%. I do think that in the future, we're going to see this one go up slightly. Return on invested capital for Meli sits at 12% at the moment. This is also, just like Amazon, one of those companies that management's track record speaks for itself. They know what they're doing. Every dollar that goes into the business is going to be spent to make sure that Meli's ecosystem becomes better and better. And well, the walls become higher and higher for the competition to have, well, bigger struggles to come in. Despite its size, TPV last quarter increased 40.5% and GMV increased 27.8%. And you can see that this has been the third quarter in a row where we've seen an acceleration in growth. Looking at the chart right now, we can see that we are here as well a bit in no man's land. With MercadoLibre, RSI was very close to being oversold on a Thursday. Now here, if we look at the drawdowns, you can see that currently we are in a cycle where it's at 28.2% from the peak. Now, how many times did that happen? Well, apparently every 11 months or so. Every 11 months. Every 4 months or so, there is a 5 to 6% drawdown. Every 13 months or so, there's a 10 to 15% drawdown. And every 22 months, 15 to 20%. That's the average frequency, of course. And yes, I know, MercadoLibre operates in Brazil, Argentina, South America. That region is not that stable. I understand it, but that region has not been stable before, and it might not be stable in the future as well. And despite all that, MercadoLibre has been growing and growing in a profitable way quite rapidly over the last decade plus. Great companies can overcome bad administrations, bad fiscal policies. That's what great companies with great management do. Moving on to the last one, and that's Meta, also a stock that is basically flat year to date. Meta is worth $1.5 trillion, has a trailing PE of 26.3 times and a forward PE of around 19.9 times. Margin profile, of course, goated. And so what has happened with Meta? Is the business not performing? No, it's again the same, maybe not the same as 2022, but it rhymes. They're going to spend a lot of money. Market is not sure whether or not it makes sense, whether or not the return on investment is going to be there. And so we're back under $600 per share. Looking at what analysts are expecting this company to do, sales growth are expected to decelerate from here on out, 19.1% year-over-year growth in fiscal 25, 16 fiscal 26, and 13.8% year-over-year growth in fiscal 27. As for free cash flow is expected to take a hit this year and next fiscal year, but then accelerate 32.3% year-over-year growth in fiscal 2027. You can clearly see what's going on with this company right now. Huge investing cycle, and that's also why we're seeing here that free cash flow margin does drop, but we're still here at around 23.7%, and gross profit margin did improve. Now, luckily for Meta, it's an insanely profitable company. Operating margin 43.2%. Looking at capex, you can clearly see again what's going on right now. But look at this return on invested capital for Meta annually. Right now, we're sitting at 27.7%. If that's the case, now, of course, the peaks previously were much, much higher because, well, they didn't really invest as much as right now. But you're still here, and the 2022 bottom was 20.2%. Just so we're clear, we're still here at 27.7%. Looking at their track record, looking at the business right now, why wouldn't they invest so much? If this is currently their ROIC, it just makes sense. A lot of the leaders have been saying, look, we rather overbuild than underbuild. And especially with Meta, if they overbuild, they can always do a Meta cloud service. They've been giving us a couple of hints here and there during earnings calls. It's not their plan to do it right now, but if they were to overbuild, well, here is the solution. But in the meantime, we have seen that AI already makes their core business more efficient and more profitable. Now, whatever happens with Reality Labs and AR and VR and all of that, TBD, the Ray-Ban glasses are a big hit. The VR headsets are always a good hit towards the end of the year, holiday season. We'll see how these things evolve. But in the meantime, you have this family of apps still dominating, still growing, daily active people, still somehow they managed to continue to increase that 7.6% growth year over year. And so yeah, as one of the probably the cheapest Max 7 name right now, Meta is on the list. Looking at the stock, this one is also a bit in no man's land. It is oversold. We do have 5 to 10% drawdown every 3.5 months, 10 to 15% drawdown every 18 months. We're currently in a 27% drawdown, and those drawdowns over 20% happen every 18 months. Again, the average frequency. And so 7.3% ladies and the rest gentlemen, this is it for me in this video. Hope you enjoyed. Do check out fiscal.ai down in the description and in the pinned comment, and see you all in the next one. Bye bye.